Well, a new plan proposed by SEC Chair Gary Gensler could shake up the retail stock trading rules by requiring trading firms to directly compete to execute trades from retail investors. This coming in an effort to make the market more transparent. According to Gensler, to discuss the implications for trading platforms, let's bring in Stephen Sikes. He is the COO of Public.com. Stephen, your platform did away with payment for order flow some time ago. So I'm curious how you're looking at this SEC proposal, and we should point out it's certainly far from done.
Yeah, I think that's exactly right. And anyway, thank you for having me, and for your viewers' benefit. Just quickly, Public is an investing app focused on helping people and retail investors build great modern portfolios, ultimately with the in service of being great long-term investors and having the best outcomes they do. And so everything we've done, from building a great product, building a great community, to building a great business, ultimately ladder back to that idea of helping people be great investors. And I think that comes back to sort of the PFOF decision. So back in February 2021, we decided to do away with PFOF because we didn't think that building in that revenue model into our business was ultimately going to be aligned with our retail investors' best interests. And since we've made that change, and we've learned a lot about the market structure and the different approaches we can take to executing retail orders that aren't sort of accepting rebates and aren't directly sending those orders to wholesalers or market makers. We found that there are actually a bunch of other ways that we can improve upon the pricing and the execution quality that you get from sort of those quote unquote PFOF routes, those PFOF market makers. And I think we've had great conversations with regulators, including Chair Gensler, about exactly those facts. And we're encouraged to see regulatory action that really aligns with what we've learned in the market in the last 18 months.
So, Stephen, it's Brian Cheung here. Great to have you on the program. So just to be clear with our viewers, I mean, this payment for order flow situation is where brokerages will route trades through a wholesale market maker like a Virtu Financial or a Citadel Securities. And if those wholesalers get a better price than what the investor ordered, they split the bounty among themselves, the brokerage that could be passed on eventually to the investor. So some might look at that model and say, well, investors are getting better trade executions through this model. So what is Public.com's response to that? How do you try to get price improvement? Do you go straight to the exchange? What's the model you work with?
Yeah, so it's interesting. So when you define sort of price improvement, and I think sort of the stats that you alluded to earlier and sort of splitting up the bounty, it's all based on sort of doing better than the NBBO. But what we've found as we go to market is there are many, many sources of liquidity that aren't factored into NBBO. Right. And so what we can do is we can go to market and we can take every one of our members' orders and we can go and look at all of the available venues to execute that order and find the best available price, often at rates that are much better than what's being reflected in the NBBO. And so if we deliver that price directly to our members without taking a cut for ourselves, so effectively taking the middleman of market makers out of that equation, we're able to deliver better prices back to our members. And again, it's not as though there's some kind of magic. We're accessing the same liquidity on behalf of our members that market makers do. It's just we're cutting one middleman out of the process and saving money for our members as a result.
Now, Gary Gensler has said that middleman can lead to some conflicts of interest, that brokerages will pick certain wholesalers because they're going to get the biggest kickback out of the payment for order flow. Do you see that conflict of interest even though you're not engaged in PFOF? Is that one reason why you haven't gone that direction?
Yeah, I mean, what we believe is building a consumer brand comes back to, especially in financial services, comes back to building trust with the investing public, with consumers, and with your existing members and customers. And again, I can't speak to other brokers' business practices. That wasn't how things, how we've ever operated. But just the fact that you can come onto TV and say that might be a conflict of interest obviously undermines the trust that an individual investor might have with the firm that they're working with. So we said, hey, in the interest of building trust and being as transparent as we can, let's avoid any of those perceived or real conflicts of interest and build a really clean business model aligned with our members.
Stephen, we're seeing another day of broad-based declines. We had our guest earlier say, look, for retail investors, you're not going to recoup the losses you've incurred this year. What has it meant for your platform? Have you seen a big pullback in activity in terms of trades?
So we haven't. We've continued to see high rates of engagement. We've continued to see sort of ongoing investment by our investor base, viewing this as an opportunity to continue to buy into the market at lower rates. I think We have not seen that trend break yet. Now it might at some point, but as we've seen so far, we've continued to see high engagement, continued trading. If anything, we've seen an acceleration of incoming flows as well as an acceleration sort of net buying activity. So more buys than sells than we would have expected sort of earlier in the year before this most recent correction.
Nothing like a good market structure conversation on a Friday. Stephen Sikes, COO of Public.com. Thanks so much for joining us today. Have a great weekend.